Waste Management is a stock I've been wanting to own for some time. I've just never really got it down to the right price. I used to own it before around the $150 mark, but I closed out of my position, which was kind of a mistake because as you can see now it's at $220, which is 11% in the past year. So let's go ahead and take a look at the stock, see where we can buy in this company once again, and take a look at its financials. Now, if we compare the stock price, how it's valued over the past 5 years, we can see it's a little bit overvalued. The intrinsic recommended value on this page is 197, and the current price, as we just saw, is 229. But I mean, if we take a look at the EPS, the company's EPS keeps increasing. Obviously, the price is falling after that. We want to see something drop and EPS increase, something like what is going on here now. That's why I'm starting to take a look at the company again. I'm most likely gonna have to wait for another quarter earnings and see if they do more earnings than 6.74, and then if they do, does the price keep dropping down? If it does, then I am very intrigued of buying in this company. But let's keep looking at some more financials. Now, if we take a look at financials such as revenue, operating income, and net income, also free cash flow, which are some metrics that you should take a look at when investing in a company, you can see that everything is pretty much in the green and will continue to do so. And if we take a look at their revenue, their 3-year, 5-year, 10-year KGR is going to be sitting at 8, 10, and 6%. However, if we take a look at the competitors, we can see that Waste Management does not have the best numbers in this case. However, you do have to take a look at the revenue that they're making. So I'd rather make 8% of 24 billion than 18% of 4 billion. Moving on, if we take a look at the assets versus liabilities, we can see that they have currently 45.7 billion in assets and 36 billion in liabilities. The assets did increase just now because they did an acquisition, which I'm going to show you now. From this acquisition, their debt actually raised as well in 2025. As you can see, I asked ChatGPT why this was, and this because they acquired this company called Stericycle, and pretty much they're very similar to what Waste Management does, but their niche is in the medical industry, such as medical waste, sharps, pharmaceuticals, and controlled substances. Now, if we take a look at this chart showing the total revenue with the total debt with the overall P/E ratio of the company, we can see that the debt and the revenue, they both have been increasing. Obviously, the debt had a huge bump due to the acquisition. However, the P/E ratio is not as high as this point here, but this is still what I won't be looking at buying this company. I want this company under a 30 PE. I think will be a great buy for me. Again, not financial advice. This is just my own opinion. And then taking a look at more metrics such as gross margin and free cash flow margin that we saw previously, it's sitting at 9% and gross margin is close to 40%. Anything over 40 is usually very good on a company. It indicates that the company has a lot of moat, a lot of market share, and it'll be very hard to lose its market presence. Now, before we take a look at the actual intrinsic value of this company, we're going to go ahead and see what the Wall Street analysts are forecasting for the stock. So they forecast an average price of 259, a high price of 288, and a low price of 198, meaning that the stock will be overvalued right now. They do have a dividend yield of 1.37%. That pays you a dividend of $3.15 per share, and that comes with a payout ratio of only 43%. They have a 5-year growth rate of 8.23, which is very good for the current dividend yield that it's at, and their dividend growth is 21 years. That means they have not cut their dividend for over 21 years. One thing that I'm not liking about the stock is that since it's dropping now in price, there hasn't been any buybacks from the company itself. There has not been a lot of insider buying, and their debt has increased, which is not good when you're seeing such a huge company. But obviously we gotta understand the acquisition, but this I don't understand. This shows me that the stock is still overvalued. Once I see their investors and their buying back once I see the own stock itself buying back its share, so the company itself buying back its share, then again, this is just going to be a little more a pointer that maybe now is a good time to get in this company. Now, taking a look at the intrinsic value with the current financials, the stock in the base case would be worth about $197. The best case, the stock would be worth about $282, being currently undervalued at 18%. And in the worst case, the stock is only worth $156, being overvalued by 32%. This company has had significant growth. I mean, this is definitely a company I want to have in my portfolio, not only because it's growing its revenue, it's paying a dividend, it has a good dividend growth rate, which is sort of the company I'm looking now to add to my portfolio. So we're just going to have to wait and see what happens if it drops, hopefully a little bit more in time. And then that's when I'll be looking to get into this company. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you in the next video.